Hello everyone, welcome to Merit Article. In today's video, we're going to debunk 8 common myths about credit scores that you might have heard. Credit scores play a crucial role in our financial lives, yet there are many misconceptions surrounding them. So, let's set the record straight with some straightforward explanations. But before we dive in, if you find this information valuable, please remember to hit that like button, subscribe to our channel, and ring the notification bell so you never miss out on our latest educational content. Let's get started. Myth number 1, closing old accounts improves your credit score. Contrary to what some may believe, closing old credit accounts can actually harm your credit score. This is because the length of your credit history plays a pivotal role in determining your creditworthiness. When you close an old account, you effectively shorten the average age of your credit history. This reduction can be viewed unfavorably by lenders, potentially leading to a decrease in your overall credit score. Additionally, closing old accounts may also impact your credit utilization ratio, which is the percentage of your available credit that you are currently using. This ratio is an essential factor in assessing your creditworthiness, and closing accounts can disrupt this balance, potentially affecting your credit score negatively. Myth number 2, a higher income means a better credit score. It's a common misconception that a higher income directly translates to a better credit score. However, this is not the case. Lenders primarily focus on your financial behavior, rather than your income level, when evaluating your creditworthiness. Factors such as your payment history, credit utilization, and the length of your credit history carry more weight in determining your credit score. Therefore, someone with a modest income who manages their credit responsibly can have a higher credit score than an individual with a substantial income who does not handle credit well. Understanding this distinction is crucial for establishing and maintaining a healthy credit profile. Myth number 3, bad credit can't be fixed. It's a widespread belief that once you've acquired a poor credit score, there's no way to reverse it. However, this notion is simply not true. Bad credit is not a permanent condition. Through adopting responsible financial habits, individuals with less than ideal credit can actively work towards improving their creditworthiness. This process typically involves making consistent and timely payments on existing debts, which demonstrates financial responsibility to potential creditors. Additionally, reducing outstanding debts and managing credit in a responsible manner are integral steps in this journey towards a healthier credit score. While it's important to note that improvement may not be instantaneous, with determination and dedication, individuals can steadily see positive changes in their credit standing. Myth number 4, closing a credit card immediately erases its history. Many individuals mistakenly believe that when they decide to close a credit card account, its payment history disappears from their credit report entirely. However, this is not the case. When you choose to close a credit card account, the payment history associated with that account typically remains on your credit report for a significant period of time, often several years. This means that both the positive and negative aspects of that card's payment history continue to factor into your credit score during this duration. Therefore, it's crucial to carefully consider the implications of closing a credit card account. Retaining older accounts with positive payment histories can often be advantageous for your credit score, as it demonstrates a more extensive and established history of responsible credit utilization to potential lenders. This can contribute positively to your overall creditworthiness. Myth number 5, all credit scores are the same. Credit scores can vary depending on the credit scoring model used. While many people are familiar with the FICO score, there are other scoring models like Vantage Score, and even within these models, there are different versions. Each model has its own proprietary algorithm for calculating credit scores, considering various factors such as payment history, credit utilization, length of credit history, and types of credit accounts. These variations mean that your credit score may not be identical across different scoring models, although they should generally be in a similar range. Furthermore, some lenders may use their custom scoring models tailored to their specific lending criteria. Therefore, it's important to recognize that the credit score you see may not precisely align with the score a lender uses when evaluating your creditworthiness. Myth number 6, applying for multiple credit cards at once won't affect your credit. When you apply for credit, whether it's a credit card, loan, or mortgage, the lender typically performs a credit inquiry to assess your creditworthiness. These inquiries are classified into two categories: hard inquiries and soft inquiries. Hard inquiries, which occur when you apply for new credit, can impact your credit score. Each hard inquiry typically results in a minor decrease in your credit score, as it suggests you may be taking on additional financial obligations. If you apply for multiple credit cards or loans within a short time frame, these inquiries can add up and temporarily lower your credit score. However, it's important to note that this effect is usually short-lived. As you manage your new credit responsibly by making on-time payments and keeping your credit utilization low, your credit score should gradually recover and may even improve. Myth number 7: credit utilization doesn't matter as long as you make minimum payments. Your credit utilization ratio is a key factor in determining your credit score. It reflects the percentage of your available credit that you are currently using. Maintaining a high credit utilization ratio, typically above 30%, can have a detrimental impact on your credit score. Lenders interpret high credit utilization as a potential sign of financial strain, which can negatively affect your creditworthiness. To maintain a healthy credit score, it's essential to aim for a low credit utilization ratio by paying down credit card balances and using credit responsibly. By doing so, you demonstrate to creditors that you can manage your credit effectively, which positively influences your credit score. A good rule of thumb is to keep your credit utilization below 30% of your available credit limit. Myth number 8: paying off all your debts will instantly give you a perfect credit score. Paying off your debts is undoubtedly a responsible and positive financial action. However, it's important to recognize that achieving a perfect credit score is not an instantaneous process. Your credit score takes into account various factors, including your payment history, the length of your credit history, your credit mix, and recent credit inquiries. While paying off debts can have a positive impact on your payment history and credit utilization, it may not address all the factors influencing your credit score. Additionally, your credit score is a reflection of your credit history, so it may take time for the positive changes to be fully reflected in your score. Nevertheless, responsible financial practices, including debt reduction, contribute positively to your creditworthiness over time. To continue improving your credit score, maintain on-time payments, keep credit utilization low, and manage your credit accounts responsibly. Over time, these actions will help you build and maintain a strong credit profile. Thank you for watching. If you found this information valuable, don't forget to hit that like button and subscribe for more insightful content. This is Merit Article. See you in the next video.